Good morning, one and all. Welcome back to the next class, that is exempted incomes under section 10, part 2. Okay, according to your convenient, I divided this exempted income into parts. So today we are going to discuss the part 2. In this part 2 here, few sections are there, that is exemption under section 10, subsection 7 on perquisites and allowances paid by the government to the employees outside India. Okay, perquisites and allowances here. Those who are working outside India, the amount should be paid by the government of India. Okay, for them here, these amounts should be completely tax-free amount, exempted amount, the allowances and perquisites. Whereas here, the salary of the employee would be deemed to be accrue in India, on which the employee would be taxed. However, the perquisites and allowances paid to the employee would not be taxed. To claim exemption, the income should be charged under the head salary income, and it should be paid by the government of an Indian citizen, whether resident or non-resident, for the services rendered outside India. Those who are rendering the services outside India, the government itself, they are paying the salaries, as well as the perquisites and allowances are allowed for the employees outside India. On these perquisites and allowances, no need to show in income tax at the time of filing. So here what happens, it is a completely tax free. On their salary they have to show, and the salary should be taxed. Okay, the next one here, exemption under section 10 subsection 8 on income paid to employees of a foreign country working in India. Okay, foreign people, those are working in India. Here you observe carefully, if a foreign citizen is working in India under the scheme of cooperative technical assistance program, and there is an agreement between the government of India and the government of foreign state, the agreement is made in advance only. Okay, here the income earned by the individual would be exempted from tax. The income should be paid by the government of this foreign state. Okay, and the individual should not have any income arising in India. Already the income those who are getting, for them the government of foreign state is already paid, then there is no chance for arising in India. Okay, then here section 10 subsection 8a, if an individual who is a non-resident, not an Indian citizen, or a citizen but not ordinary resident in India, is a consultant from an international organization, any fee or remuneration earned by him would be exempted from tax under section 10(8)(a). This section says that any consultant from an international organization, for them fee or remuneration is paid, okay, by India, by Indian government. Here this amount should be a tax-free amount and it should be exempted amount. Okay, to claim the exemption, the organization for which the consultant works should derive its fund from a technical assistance grant, and which is given by the foreign government under an agreement. Here the agreement is mentioned advancedly, it is done. The technical assistance provided by the consultant should be as per the agreement. The appointment of the consultant should also be approved by specified authorities. Okay, in meanwhile the advance agreement is made between these foreign state as well as the government of India. According to this agreement under this section, okay, the fee or remuneration paid to them, it is a fully exempted. Okay, the next one, section 10 subsection 8b, if the consultant mentioned under section 10(8)(a) employs and pays an individual any remuneration for services rendered in India under the technical assistance program, such remuneration would be tax exempt. Already we discussed in the previous slide that remuneration and fee is a tax-free income. Here again, the individual should not be an Indian citizen, or if he is an Indian citizen, he should not be ordinary resident in India. Any other income of individual outside India would also be exempted if it is subject to tax in a foreign country. Okay, because it is subject to tax in foreign country. In the foreign country itself, they are paying the tax. Okay, then here what happens? The income or the amount, the fee which is paid by us, the remuneration is given to them. It is a tax free, because in advance the agreement is made between the two countries, and the condition is that here Already they are paying the tax in the foreign country. Moreover, the individual service contract should be approved by the specified authority to claim exemption. Okay. Then next one here, exemption under section 10 subsection 9 on the income of family members of individual here. Family members of individual working in India under cooperative technical assistance programs. If the family member of individual referred under section 10 8 8a and 8b comes to India with the individual and earns an income outside India. They comes to India with individual and earns income outside India. Such income would not be taxed in India. The income would be deemed to be accrue outside India, for which the family member of the individual would have to pay an income or a social security tax to the government of country which the income originated, where the income is originated. For them only these exemption under section 10 and 9 it is applicable. Okay, the next one here, exemption under section 10 subsection 10 on gratuity income received by an employee. Gratuity income. Okay, if an employee has completed 5 years of service with an employer, the employer pays a gratuity to the employee on retirement or on death of the employee. Gratuity is paid as an acknowledgement of the past service rendered by the employee. If the gratuity is paid on the retirement of the employee, the amount of gratuity recorded under the income from salary. However, gratuity paid to legal hire on the death of the employee would be recorded under the head income from other sources in the tax return of the legal hire. Okay, completely this gratuity amount is a tax-free amount, no need to pay any income tax after the retirement. Okay, and it is an acknowledgement for them, gratuity. Okay, the next one here, section 10 subsection here 10 is there, exempt gratuity received by employee up to specified limit. There are few limits are there. Any gratuity paid to a government employee on death or retirement would be tax exempt under this section. If gratuity is paid to a non-government employee by an organization covered under the Payment of Gratuity Act 1972, a specific portion of gratuity would be exempted from the tax under this section. Okay, he is not a government employee, he is a private employee. There is a specified portion of gratuity would be exempted. The exempted amount of gratuity would be lowest of the following here. Amount of gratuity received: 15 days average salary of the last 3 months for each completed years of service. If in a year the employee has worked for more than 6 months, it would be considered as 1 full year of service. In the case of seasonal establishment, however, 7 days salary is considered for calculation of exempted limit. Salary would be basic salary and dearness allowances. Okay, here formula also there. Based on this formula it will be calculated, and the previous class also we discussed. Again I am repeating here, okay, regarding gratuity. If however gratuity is paid to any other employee, that is non-government employee of an organization not covered under the Payment of Gratuity Act 1972, the exempted amount would be lowest of the following. Amount of gratuity received, how much they received, half month average salary for each year of service. Average salary would be mean the average salary of the last 10 months. Okay, again here a small formula also there. Based on this formula it will be applicable. If the gratuity is paid on death, termination of service or disablement of the employee, the aforementioned exemption is allowed. However, if the employee avails gratuity while being in the service with the same employer, the gratuity received by would be taxed under head income from salary. If the employee has availed gratuity earlier and had claimed an exemption under this section, he would be eligible for further exemption if gratuity is received again. Okay, 2 times the eligibility is here to show the under the exemption, and 2 times the eligibility is there to avail the service. In that case, however, the limit of Indian rupee 20 lakhs would be reduced by the exemption already claimed by the employee. Okay, the next one here, exemption under section 1010A, a commuted pension. If an employee has a pension fund on his name, pension fund on his name after retirement, a part of the fund can be commuted. Commutation of the pension means withdrawing a part of the fund in a lump sum. Okay, the remaining fund is then used to pay pensions. This commutation of the pension is allowed as a tax exempt income. The exemption is allowed on the commuted part of the pension, and the limit of the exemption is as follows. Okay, here a part of the amount withdrawn for the payment of the pension in advance when he is in the service, that amount should be completely tax free. When at the time of his retirement, the amount will be withdrawn for him. Okay, if the employee is an employee of a government, statutory corporation or local authorities, the exemption is allowed on the total commuted value of pension. If the employee is a non-government employee and he has not received gratuity, half of the pension corpus can be computed tax free for the government employee as well as non-government employees. A little bit difference is there, observe carefully. If the employee is a non-government employee and has received gratuity, 1/3 part of the corpus can be commuted, and the commuted pension would be exempted from tax. For other individuals, that is those who are not salaried, tax exemption is allowed on the commutation of pension received from a fund as specified under class 23 AAB. The tax exempt commutation would be limited to 1/3 of the total corpus. Okay, this commutation of pension is very much important, and the pension, okay, before 2005 the pension system is there. After 2005 it is removed. Then here what happens, they are paying some little part of the amount to get the pension after retirement. On that amount also the tax exemption is there for government employees, non-government employees, and non-government employees, those who are not receiving gratuity. So here these are the exemptions under the this section 10 subsection 10a. The next one, exemption under section 10 subsection 10AA on leave encashment received on retirement. Leave encashment on received on retirement. This is also very important one and interesting one. If an employee retires from service and receives leave encashment, the amount received would be exempted from tax. The limit of the exemption would be as follows. Okay, leave encashment means here some paid leaves are there for them. Okay, if they allow these paid leave for them, the payment will be made after the retirement on this amount also. Under section 10 subsection 10AA, the exemption is allowed. Okay, if the employee is a government employee, the full amount of leave encashment received would be tax free. Okay, if the employee is a non-government employee, the exemption limit would be lower of the following. Okay, lower of the following means here amount of leave encashment received, lower amount again, the average salary of the last 10 months preceding to the retirement date. The salary would be include basic salary, dearness allowance, and commission expressed as a percentage of sales. Cash value of leave which the employee did not avail, this would be calculated assuming a leave of 30 days for each year of service. Okay, this is the way, these are the conditions which we are going to apply for the leave encashment received on retirement of a government employee as well as non-government employee. Okay, the next one, exemption under section 10 subsection 10b on retrenchment compensation paid to workmen. If a workman is terminated from employment, which is called retrenched, okay, the employer pays compensation to the worker at that time. This is called retrenchment compensation. Okay, retrenchment compensation, we can say it one. Then here what happens here, when they are terminated in meanwhile, when they are in the service, for them this amount will be given. This exemption, this compensation is payable under the provisions of the Industrial Dispute Act 1947 and other rules of act issued by the government. Any standing order or through an award, service contract, or otherwise. Okay, why they are removed means here standing order, any order from the higher official or through an award. Okay, service contract, previously there is a contract, for example there is an agreement between the employer and the employee, or otherwise any case, then immediately it will be applicable. The compensation received by the workmen would be exempted up to a specified limit which is considered to be the lowest of the following here. Okay, amount of retrenchment compensation received, that is 15 days average salary for each completed year of service. Okay, how many years he rendered service, in that year On an average, 15 days will be average salary for each completed year. 15 days will be taken into consideration. If the workman has worked for more than 6 months in a year, that year would be also considered to be a complete full year. If the workman receives an amount higher than the maximum exemption limit, the excess amount received would be subject to tax under the head income from salary. However, the workman can avail a tax relief under section 89 of the Income Tax Act 1961. Read with Rule 21A. Moreover, if the workman receives their retrenchment compensation under any scheme introduced by the central government of India for the welfare of the workmen, the entire amount of the compensation received would be exempted from tax. There would be no exemption under or the exemption limit on such compensation. So here, meanwhile, when they are in the job, based on their agreement, according to their contract, if they are removed from their retrenchment from their job, then immediately the amount what they are going to receive on that amount under the section 10, subsection 10b, the retrenchment compensation paid to workmen is a exempted amount. According to these conditions, based on the 15 days average salary each year, it will be calculated. Okay, then according to that, this amount also be a tax-free amount. The next one, exemption under section 10BB on compensation received for Bhopal gas tragedy. Okay, this Bhopal gas tragedy, okay, it is happened long back. Any compensation paid to an individual under Bhopal gas leak disaster processing claim act 1985 would be considered to be a tax exempt. Those who are the sufferer at that time, individually, those who are suffered for them, any amount received from the government, that amount should be a tax-free amount. However, the compensation is paid against any loss or any damage for which the individual has already claimed a deduction. The compensation received would be taxable. Okay, they applied, then they received some amount. That amount should be a tax-free amount. Okay, or here sometimes what happens, any damage for which the individual has already claimed a deduction, they already done, they claimed, the compensation received would be taxable. After deduction is happened, after deduction has taken place, then then after what happens here, if they received any compensation, that should be a taxable amount. If they are not deducted, it is a tax-free amount under Bhopal gas tragedy section 10, subsection 10BB. Okay, the next one here, exemption under section 10, subsection 10BC on the compensation received for any disaster. Okay, if an individual or his legal has received compensation from the government or local authority for a disaster. Okay, nowadays you observe disaster is happening, huge rainfall, any earthquakes, any natural calamities are happened, they are considered as a disaster. Okay, such compensation would be exempted from tax. If they received for their damage from the government, that amount should be exempted from tax free. However, if the individual or legal hire suffered a loss due to the disaster and they have claimed a deduction in the Income Tax Act 1961 for such losses, the compensation received would be taxable. Okay, you observe carefully, already they suffered a loss due to the disaster, they have claimed a deduction in the income tax. At the time of calculating income tax, they already deducted. Again, this amount should be not tax free. Again, if they received, it should not be tax free. The term disaster would be include both man-made causes and natural disasters which cause considerable loss of life and or damage to property or the environment. Moreover, the extent of disaster should be beyond the coping capacity of a community of individuals in the affected areas. Okay, nowadays you observe the coronavirus is taken place complete whole wide. So here what happens, any sections or any new things are introduced by the government of India under the coronavirus who are affected severely, for them some amount will be given. If they are, this amount is shown in their income tax, if it is deducted, then it should not be a tax-free amount. If they are not deducted, this amount should be a tax-free amount, because advancedly they are getting some claim, or they are not deducted, then after also they are getting the claim. So it is a exempted amount based on the disaster. Okay, the disaster is a man-made disaster or a natural disaster. In any way, the disaster is happened. If the based on that the property or environment or any losses happened, then this amount will be given by the government. This amount should be exempted under section 10 subsection 10 BC. The next one, exemption under section 10 10C on a compensation received at the time of voluntary retirement. Here few people they take a voluntary retirement okay before the 60 years. The retirement age at some departments is 60 years, at some department is 58 years, at some organization it is a 65 years. Okay, 58, 60, then 65 years. These are three criteria, and based on the state also it is applicable. Before that retirement date, those who are taking the voluntarily retiring, okay, under that if they received any compensation, then should be a tax-free amount. So you observe carefully here. If an employee voluntarily retires from employment, compensation is paid to him. Such a voluntary retirement would be exempted from tax. Okay, here the exemption would be allowed to the employees of following types: organizations, you observe carefully, public sector companies, any other non-public sector company, the authority which has been established under the provincial, state or central act, local authority, cooperative society, university which has been established under the provincial, state or central act, including an institution which has been declared a university under the provision of section 3 of University Grants Commission Act 1956. In IITs here, which fall under the meaning of section 3 class G of Institutes of Technology Act 1961. Management institutes which have been specified by the central government by notification of official gazette, state or central government. Institutions, okay, here institutions which have importance either throughout the India or in one or more states of India. To claim an exemption on voluntary retirement compensation, the following condition would have to be mentioned here. Okay, these are the few organizations we have taken. In these organizations, those who are taking voluntary retirement, okay, for them after the voluntary retirement they will get some amount. On that amount, the amount should be a tax-free amount according to this section 10 subsection C, the compensation received at the time of their voluntary retirement, those who are working in all these organizations. Okay, the next one, the compensation should be received only when the employee voluntarily retires from the company or when his service are terminated by the company under any scheme of voluntary retirement. In case of public sector companies, the compensation should be paid under the scheme of voluntary separation. The compensation can be paid in the lump sum or in installments, and exemption would be allowed under both the cases. Okay, sometimes what happens with that company, the amount, sufficient amount is not there at the time of their voluntary retirement, then the amount will be issued to them on installment basis, or sometimes they paid in lump sum also. But these both two amounts are fully exempted in the both cases. Okay, then here the voluntary retirement scheme of the above mentioned organization which governs the payment of the compensation should be framed in accordance with the prescribed guidelines of Rule 2BA of the Income Tax Rules 1962. The exemption for voluntary retirement compensation can be availed by the employee for one assessment year only. If availed, the exemption would not be allowed for any other assessment year. Only for the one assessment year it is applicable. So you observe carefully, these are the few conditions under this section, and if the employee has claimed the tax relief under section 89 of Income Tax Act 1961, 10C would not be allowed. Okay, the amount exemption allowed under section is Indian rupee, that is 5 lakhs, or the actual compensation received by the employee, whichever is less. The maximum amount is 5 lakhs. Suppose they received 4 lakhs 50,000, it should be exempted. Then here under section 10 subsection 8 subsection 10 CC on non-monetary perquisites paid by the employer. Non-monetary here, you observe carefully. Perquisites are additional benefits and the facilities which the employer provides to its employee. Perquisites can be monetary as well as non-monetary in nature. Okay, if an employer provides non-monetary perquisites to the employees and pays tax on such perquisites on behalf of the employees, the tax paid by the employer would be allowed as an exemption in the hands of the employees. Okay, here perquisites means here some additional benefits which are given by the employer for the employee in the form of monetary as well as non-monetary benefits here. Okay, here non-monetary benefits also they are claiming under section 10 subsection 10 cc to the employer will be providing for the employee. Okay, it will be deducted under this section. The next one, exemption under section 10D on benefits received from the life insurance policies here. So generally you observe for each and every individual this LIC providing few benefit also under section 10D on benefits received, the benefits are received by them. If an individual receives any amount from life insurance corporation or life insurance policy including any bonus on the policy, the amount received would be fully exempted from tax without any maximum limit here. There is no limit. Suppose you paid for 10 years, after 10 years the bonus will be given for on few policies, the bonus amount will be fully exempted here. However, the claim exemption based on the following condition should be fulfilled. If the policy was issued on or before 31st March 2003, before 2003, any amount of money received from the policy would be exempted from tax. If the policy is issued on or after 1st April 2003, but before 31st March 2012, the premium should not be less than 20% of the sum assured of the policy. If the premium is more than 20% of the sum assured, the exemption would not be available and policy benefits would be taxable in the hands of policy holder. For example, here, if the premium is rupees 20,000 and the sum assured is 2 lakhs, the benefit received would be completely exempted from tax. Okay, however, the premium is Indian rupee 50,000 and the sum assured is 2 lakhs, the benefit received from the policy would be taxable here. Okay, 20% only here, below 20%. Okay, in this case here, what happens? First time he received 20,000, in the second time he received 50,000. On 20,000, its amount is a tax free, it is benefited for them. If he received 50,000, then it is a not benefited, it should be taxable. Okay, it is made in the condition. This condition is we are going to apply. If they are satisfied with the condition is satisfied, then it is a tax free amount. If the condition is not satisfied, it is a paid amount, not tax free amount. If the policy is issued on or after 1st April 2002, the premium should not be more than 10% of the sum assured of the policy. Okay, you observe this one. Okay, this comes under policy here. If the premium is more than 10% on sum assured, the exemption would not be availed and the policy benefit would be taxable in the hands of policy holder. Okay, here small example also given here. 15,000 you received, sum assured is 2 lakhs, the benefits would be exempted from tax free. Okay, 10% means 20,000. Below 20,000 it is there, it is a tax free amount. However, premium is 25,000, the benefit would be taxable here. It is above 20,000. Okay, then it's a taxable amount. If the policy is bought on after 1st April 2013 for an individual who suffers from any disease specified under section 80DDB of the Income Tax Act 1961 or from a disability has specified under section 80U of the Act, the premium should not be more than 15% of sum assured of the policy. Okay, here the few of the sections are there. The next one here, life insurance policy pays a death benefit. The above mentioned condition would not be applied. The death benefit would be fully exempted from tax if they in the hands of nominee, whatever the amount. Moreover, the exemption would not be allowed on the policy benefit received under a key man insurance plan under section 80DD3 or under section 80DDA3 of the Income Tax Act 1961. Okay, on the death, if they received by the nominee, the amount should be completely tax free. Okay, but the condition is here, key man insurance policy also there. For them, it is not applicable. If you want to avail tax benefits on life insurance policy, okay, here few steps are there. Okay, you can click on the steps also, but it is not applicable here. It is not appeared in our class, so no need to worry. I will do another video also. The next one here, exemption under 10 subsection 11 on the payment from statutory provident benefit. The exemption is allowed on payment made to an employee from a statutory provident fund set up under the provisions of the Provident Fund Act 1925 from any other provident fund established by the central government through a notification of the official gazette. The employer contribution to such fund is not treated as an income for the employee and therefore not taxable in the employee hands. Okay, then here what happened, the termination of the service are also completely exempted from the tax for the employee here. Statutory provident fund, this one. Then next one is it is also recently we are listening this word, that is Sukanya Samruddhi Yojana. If an individual opens a Sukanya Samruddhi account in accordance with the Sukanya Samruddhi account rule 2014, which have been created under the Government Savings Bank Act in 1873, payment from the account would be exempted from tax. This payment includes the interest earned, partial withdraw from the account as well as the lump sum benefit received on termination on the maturity of the account. Okay. The next one, exemption under section 10 subsection 12 on the payment received from the recognized provident fund. Okay, recognized provident fund also there. On that, this section will be applicable. You observe carefully. Okay, these are the few exemptions. The next one here. See here, you observe carefully. Public provident fund interest earned or lump sum amount received from the fund on termination of the service would be exempted from tax. Lump sum or interest are received on a public provident fund, it should be a tax-free amount here. The next exemption under section 10(12)(a) on the amount received from NPS, National Pension System, trust or any other pension scheme has mentioned under section 80 CCD and then closes the scheme, the money received from the scheme would be exempted from tax. The exemption would be allowed for up to 40% of the money received. However, from 1st April 2020, the limit has been increased to 60% here. This is updated information here. National pension scheme here, for individual who invest, it will be a tax-free amount if they received on the scheme. Exemption under section 10(12)(b) on partial withdrawal from NPS. Partially, the part a little bit amount will be withdrawn. That should be also tax-free amount here. Partial withdrawal from the scheme, the money withdrawal would be exempted from tax. The exemption would be available for up to 25% of the balance withdrawal from the NPS account. Moreover, the withdrawal should be done as per the terms specified by the Pension Fund Regulatory and Development Authority Act 2013 and any other regulations made in the act. Based on this, we are going to do. Exemption under section 10 subsection 13 on payment from an approved superannuation fund. A superannuation fund is like a pension fund which is created to provide retirement benefits to its employees. The fund is created under a trust to pay annuities to employees of the organization on their retirement, incapacitation to work, or on premature death. In case of premature death of the employee, annuities are paid to the widow, children, or other dependents of the employee. The fund collects contributions from the employer and employee and invest the contribution in prescribed avenues. Income earned from the investment is exempted from tax provided that the fund is a approved superannuation fund. The employee's contribution to the fund is allowed as a deduction under 80C of the Income Tax Act 1961 up to Indian rupee 1.5 lakhs. Employer contribution of up to Indian rupee 1.5 lakhs per year for the employer exempted from tax here. On superannuation also some amount, some benefits will be given for them. At that time, these amount also be a tax-free amount here under section 10 subsection 13. Any excess contribution, however, would be taxed in the hands of the employee. If any payment is received by employee or his family from the approved superannuation fund, such payment would be exempted from the tax provided any of the following conditions here. The beneficiary dies, employee commutes his annuity on retirement, or at the specified age, or when the employee becomes incapacitation before retirement here. The contribution are refunded on the death of the beneficiary. All this amount will be deducted, or it's a tax-free amount for them. The money is transferred to a pension account of the employee of a pension scheme, which is mentioned in the section 80 CCD and notified by the government here. Okay, the next one, exemption under section 10(13)(a) on house rent allowance. House rent allowance is nothing but HRA, is a salary component of almost all salaried employed provided by the employer to meet the rent of accommodation of the employee. This HRA received from the employer is exempted from tax in the hands of the employee up to a certain extent. This limit of exemption allowed is the lowest of the following here: 50% of salary if the house is in the metro city like Kolkata, Mumbai, Delhi, Chennai, else 40% of the salary here. Okay, suppose your salary is to 50,000, 25,000 will be exempted for HRA. HRA received by an employee from the employer. The employer, they are receiving from the employee will be received from the employer. Okay, here 50% allowed in the metro cities like Kolkata, Mumbai, Delhi, Chennai. Remaining cities 40%. Rent paid in excess of 10% on salary of the employee. Okay, for computation, the salary would include the basic pay, dearness allowance, and commission if it is expressed as a fixed percentage of the turnover. Moreover, to claim the exemption, the employee should not own a residential house in his name and should live in a rented house only. It is applicable. On his name, there is no house, then only it is applicable. If it is there, then it is not applicable. Okay, so thanks for today class. Those who are not subscribed, please subscribe to my channel, Fine Telangana. Then if you have any doubts regarding our class, you can post in the comment box. In the next class, I will try to clarify your doubt. So you observe, these are the slides. Carefully you observe, and these exemptions are very, very important while we are doing the income tax returns. From the first slide, you observe carefully. In the next slide, we are covering the part 3. Okay, because it's a little bit huge topic, that is the reason I am focusing on this topic. So thank you, viewers.